All right, good morning. Good morning, everybody. We've got people logging in here. This is fantastic. Got a few more coming in, but we're at the top of the hour, so we're going to go ahead and get started. I'm so excited that you guys are able to join us here today. Thanks for taking the time out of your busy schedule. And welcome to our monthly economic outlook for December 2020. I'm actually up with my family up north today on Lake Vermilion in northern Minnesota. So if you hear any kids in the background, please excuse that. When this pandemic is over, look forward to hosting you guys all at our new office there in our new group meeting room instead of meeting virtually here like this. But of course, with the pandemic, we're doing what we can as best as we can. So first of all, just want to say welcome to all of you clients on the call here today. Thank you for, again, taking the time out of your busy schedule to check into this important update. Others of you, you've been invited by a client of ours or otherwise, and you're new here today. If that sounds like you, my name is Eric Hagan. I am president, I'm senior wealth manager here with the wealth management firm Capital Consulting Group. CCG consists of myself, our Chief Investment Officer, Tom Fox, who you're going to hear from in a few minutes, financial advisors, Rana Grant and Dan Oshman, as well as registered support staff, Ryan Dewey and Marilyn Westmark. Get my webcam turned on here too. It's like I missed that button. Here we go. All right, so I'll get that out of the way. All right, almost there. All right, bear with me there. Thank you. We're located in the northeast corner of Eden Prairie, kind of where Eden Prairie, Edina, Minnetonka, where they all come together at the intersection of 212 and Shady Oak Road. We serve individuals, couples, families here in Minnesota, as well as all across the country. We are an independent firm. We're not owned by a bank, by an insurance company, by a large financial institution. We work for you clients on the call, your best interests and only your best interests. We offer our advisory services through and are supported by nationally recognized and multiple award-winning broker-dealer, Next Financial Group. Primarily do two things. We help our clients see their entire financial situation both today as well as every year into the future. And you can learn more about that if you'd like at clearfinancialfuture.com. And then we also give our clients' life savings the attention it deserves through our fiduciary investment management services. Our flagship program is something that we call Smart Mix, and you can learn more about that at smartmixportfolios.com. We understand the trust that all of you clients on the call have placed in us, and we take that trust very, very seriously, which is why we spend a lot of time on communication. We want you all to be informed and feel comfortable with that trust that you've placed in us. If you want to know what is happening in the markets and in the economy, I invite you to join me every Monday. I do a short 3 to 5 minute economic update summarizing what happened in the markets the previous week, as well as provide some nuggets of things that we are watching for. I send out a reminder email on Mondays, so if you're not getting that, be sure to head over to our website. If you go directly to investwithccg.com/WEVU, or Weekly Economic Video Update, there's a little form at the top of that page there where you can put in your name and email. You'll get that once a week email reminder when that video update goes live. Then also on most Thursday mornings, I give a live presentation where I go deep into how Smart Mix works. If you go to smartmixportfolios.com, kind of scroll down a few ways, a little bit on that page there, a little ways, you'll see upcoming dates where you can RSVP. Be sure to RSVP so you get that reminder email on how to log in and when we're getting started. So, and then also if you go a little bit lower on that page, if you can't make it live, there's also a button where you can watch a recording from one of the previous weeks. And of course, that's available 24/7. So for those of you who are new here today, that's a great way to go deep into exactly how we manage our clients' life savings. And for you clients on the call, if you ever want a refresher on exactly how that works, I invite you to join me. You can hop on there anytime you want, and would love to have you. And then lastly, to answer the question, what are we looking at? What's coming up ahead? What does the future hold? We do these economic outlooks on a regular basis. And again, that's the primary purpose of today's call, to hear from our Chief Investment Officer, Tom Fox. Many of you have not met Tom yet. He works a little bit more behind the scenes. He has an incredible resume. few of the bullet points here. He's got over 30 years in the investment business, over 26 years as Chief Investment Officer. He's an expert in building quantitative investment approaches. He's an architect, the creator of numerous successful academically based investment strategies. He's managed over $1.5 billion at several different times. He's experienced in managing large institutional funds, including 2 mutual funds. Presented proprietary research to the Federal Reserve Board's Investment Committee, and on and on and on. He's got quite the resume you can see on your screen right there. So real quickly, as you're listening to Tom, before I hand it over to him, feel free in the chat box to ask any questions that you'd like. And when Tom is finished with his presentation, I will present those to him so that he can give us his insight into that question. So again, just head over to the chat box, go ahead and ask any questions all throughout his presentation if you'd like, or wait till the end, whatever's best for you. And I will turn those and I'll present those to him at the end. So with that, I'll turn it over to you, Tom. Tom, thanks so much for being here today. Good to see you. Let's see, I think Tom is muted. Hold on a second there, Tom. Get you unmuted.
Thank you, Eric. Good morning, everybody.
There he is. Wonderful. All right, you're good, Tom. Thank you.
All right, so we're going to look today. We're going to look at a 2020 recap of unprecedented things that happened in the economy and market this year. And I'm sure everybody's ready to celebrate with an extra bottle of champagne for a new beginning and a new year. I think all over the world, people are saying, hey, let's get a new year started, and we're almost there. We're just finishing up the last few trading days of this year. We're going to look today at the recap of 2020. We're going to then look at the first half of what we expect to happen in the first half of next year, 2021, and then again what happens in the second half and then beyond that. So I look forward to sharing this with you. But let's go over the 2020 recap. We've had one of the most tumultuous years in history, and boy, was it filled with big surprises. We saw the speed at which the pandemic escalated, and then of course the severity of the lockdowns, which I don't know if you know this, but it ended one of the longest economic expansions ever. And we also had unprecedented government stimulus. That's both in the US and globally. And this is an amazing this is for the history books, but we had record decline in gross domestic product, the GDP, and then it was followed in the next quarter by record growth in the GDP. So it was one of the fastest and shortest recessions in history. This is all 2020 is for the history books. And of course, the magnitude of the equity decline and subsequent rebound to new highs and the speed at which that occurred was really mind-boggling. And of course, now more recently, as we close out 2020, or Operation Warp Speed succeeds and we get approval and start of distribution of a COVID-19 vaccine. And just recently, Congress and Trump finally approved. Boy, was that negotiation going back and forth, but they finally approved the stimulus bill, so around $900 billion, and also approved the budget. So things are looking very, very up for as we head into the new year. This chart, I wanted to show you the speed and the magnitude of the fall and then the rally. And now this is comparatively to the 1929 rally, the 1938 rally. Of course, that's all around the Depression. And then the 1974. These were all severe market declines and economic downturns. And of course, the 2009 rally. But you can see that we are right on track to maybe break the record in the distance and magnitude of this. Now this is our smart signal. We have a quantitative program and we're very proud of the outcome that we had this year. We were able to tactically manage your portfolio. One of the things our indexes do is we try to put a measure of protection on your portfolios. Now, you can do that in a number of ways. You can do it through having one of your different choices on the risk-based outlook. For example, you go conservative or moderate or whatever your choice is. That's one way. But the other way is where we take a tactical stance. And normally we're going to be looking at about a 25% reduction in risk. And if you look on the farther up left, we took a defensive signal. This was early on in the market before it fell. We took a 25% cash position and protected 25%, which was really good timing. It was an amazing call, especially at the speed at this drop. Now you can see we went back and put half that money back in March, right towards almost the bottom. And there was only a few days that we just missed the bottom of this turn and put half of the money we took out and put it into the offense. And then as we market rallied, it got ahead of itself. And so we took a defensive signal where we dropped the added cash and added a hedge at 65%. But then as that began to unfold and we started seeing some light and some sunshine, we ended up moving into a more offensive signal. And then finally, we went 100% back in our equity position in about July 21st or so. So we were able to capture all of that move going from July all the way to where we are today. And you can see the chart. So in all, we were able to, our signals were able to protect the portfolios, give you some peace of mind, and also capture the upside as it began to change and things began to look better for the stock market.
Tom, I lost your audio. I don't know if that's just me or not. Can somebody in the chat box tell us if they lost Tom's audio?
I can.
It might just be me.
I see that it's still good on my screen.
Well, I'm going to progress a slide for you, Tom, but I lost your audio.
All right, so now let's look at possible headwinds where we are today. And what we have is the spike in COVID again. We're having the third wave, and it's a severe wave. It turned out worse than what a lot of people expected, and following the holidays. And of course, we're not done with New Year's yet and the travel that goes on. So we're expecting that this will end up maybe putting the brakes on this market rally. So that's one of the headwinds, is the more recent downturn and the closures and the restrictions that are out there. We do believe this is going to be a speed bump. One of the other possible headwinds is that if we don't get the vaccine distribution right, if it becomes inefficient in its dissemination, and we have a lag there because all the market is expecting a normal distribution, but if that gets disrupted, that's another possible headwind. And then with the investor optimism, right now there's a lot of optimism out there where we are in this market, and typically it's a contrarian indicator. So if you see that an investor optimism reaches a certain point, and we're going to see a chart on that, then that normally means we're reaching a potential top. So that's another headwind. And on the other risk that's out there, if bonds start rising and inflation comes sooner than expected, we don't expect that right now, but that is a possibility. And of course, if we do not have a divided government and Republicans don't hold the Senate in January, that could bring some negative impact to the market. Of course, we always have at the bottom of all of our possible headwinds is another major geopolitical event. The whole world is still healing. We're not healed yet. And if that happens, then that could be detrimental to the whole economy and market. So the composite contrarian indicator, this is what we just talked about as a headwind. you can see historically when we get it, if the line drops below the red line, that's euphoria. Typically, it's a counter indicator, and you can see that we're approaching euphoria right now. So this is a possible headwind that we have to keep an eye on. You can see it's gone historically several times further than we are now, but it may put some limitation on the upside of the market. So here we go, the economy and markets. This is my view for the rest of this year and the first half of 2021. And we're going to divide it into two. We're looking at the first half of this year, followed by what we expect to happen next year. Now, this is all just forecasting. It can change, it's subject to change, but this is what we believe right now will take place. We expect the Christmas rally will remain intact for the last few trading days. We had targeted about 3,800 on the S&P 500, and it looks like we may get there. We're very close right now. So we do not see anything going down between now and the last few trading days. Now, the first quarter of 2021, we're going to see a COVID-19 last surge that sends potentially the equity markets down temporarily. We could see up to a 10%. Remember, 10% is a correction. But because of the damage that's going on right now with the closures and the restrictions, we do believe this is going to be a speed bump in the markets, and we could see a downturn sometime in the first quarter of 7 to 10%. But we do think afterwards, after we get past this current spike in COVID and the vaccine gets disseminated, that we're going to see the economic engine kick up again, and this is going to be very transitional, and we're going to end up heading back up to a great year as going forward. Now, we're going to have that speed bump, we believe, but in the markets, but we also see probably new highs by mid-year as we get through all this and the market looks through it and into the future. And let's go to about the stock groups and what type of stocks do we believe will do well. We think it's going to ebb and flow because of the speed bump in the closures and the economy currently. We think there's going to be an ebb and flow between growth and technology stocks, for example, and cyclical stocks in the first half. For 2020, 2/3 of the stock market return came from technology. And we still think they're going to do well. They're going to probably deliver one more big boost in earnings at the stay at home because of all the recent surge in the economy, and it's infected the economy, the COVID. So we expect one more boost in earnings in the first half of this year. So now look, as we look at the second half, we believe that it's going to be a great stock market next year. Stocks reap the benefits of this massive infusion. Of course, we got more, and they're talking about even a second phase once Joe Biden takes his position. We'll see what happens. We also expect earnings surprise. Corporate earnings are going to do quite well with the reopening. And then, of course, they've been cutting expenses. When you have reopening, revenues increasing, and you have low cost, because every company has had to cut expenses, that will produce very high earnings, and that will end up driving stocks higher. So we believe by the end of the summer, this pandemic will begin to fade. We're estimating that by August, that this will all be in the rearview mirror, and then the economy and society will start to feel normal again, probably around September. We do believe in the second half that there's going to be a transition. I remember in the first half, we expect an ebb and flow, but we think that value, cyclicals, and small caps, which were the big underperformers this year in 2020, will begin to heat up and take leadership position and performance. We're also looking for this new economic expansion, and we do believe we're in a new economic expansion that started last year. Will probably be in excess, the GDP growth will be in excess of 5%, which is a very, very robust year. And we do believe that central banks are going to continue to maintain their ultra accommodative policy stance. We don't see any interest rates going up quickly, but for several years, we believe that central banks are going to help this world economy heal. So what do we expect by the end of the year? We're expecting about a 10+% return for equities. And we also expect favorable equity markets as we head into 2022. Now, this is an interesting chart because it shows historically economic expansions and how long they normally run. We believe this expansion started in the summer of 2020, and it was probably, as I said, will be marked as the shortest recession in history. You have to remember that the economy was humming before the plague hit the world, and especially in the United States. So we expect that it's going to be a long run. The expansions typically, on average, go 5.3 years, and we're just at the beginning. And it could be a 5 to 10 year expansion, which means the stock market will probably be in good shape for the next 5 or 10 years. There will be corrections, there will be volatility, but we think that we're at the beginning of this economic expansion. This is the benefit when the majority of central banks, this is a global statistic, and if the chart line is towards the top, that means that everybody's keeping interest rates low, they're more accommodative. And you can see where we are today, and if you look at it's percent of central banks and their last cuts, but if you look at the box on the bottom right, you can see when the chart, when the line is above 50, that the average return globally is 8.4%, and when the line is below 50, that means they're becoming more hawkish and their central banks are beginning to raise rates. Then it's only minus 0.3. So we are in globally, I think, a very good position with the coordination across the world in keeping interest rates low. Now, the inflation expectation is still below the Fed target, and the expectation is it's going to stay there. We do believe around 2023 we're going to start seeing that rise, but we're still at a very early point in the inflation cycle, and it's going to keep obviously the Fed on the sidelines. Now they have a 2% target, but they've stated because of the health of the economy and the healing process that they're going to let this run before they do anything in terms of raising rates. And we'll see that on the next chart. So here, this is a sort of a outlook going out to the fourth quarter, the end of 2023. And what it shows is that there's not much expectation over the next 3 years for interest rates to go up. So we do believe that they're going to keep rates low for up to 3 years, but it's probably 2024, the beginning of 2024, that we should start to get really concerned about rates rising and perhaps even inflation. But we have a long ways to go, and right now, the 30-year mortgage is at an all-time low. It's a great time to refinance your house or get to buy a house because this is historic lows in financing the biggest investment of everybody, and that's their home. Now, this is my last statement. This is a poster, believe it or not, from 102 years ago. And you can see death is at the door, the next to go. And it says, wear a mask, wash your hands, avoid touching your face, and maintain a safe distance from others. That poster could be today, but hopefully we're not going to see something like this for another 100 years. It seems like it runs in 100-year cycles. And I hope for everybody's sake and the world's sake that we don't see another pestilence for a long, long time. So to summarize, we expect a great year in 2021. We do expect, though, there's going to be a road bump in the first quarter because of the lockdowns and the restrictions today. But we're very bullish next year, and we're looking right now at a 10+% return in equities. And on another note, if you notice in your portfolio, we've restructured some of the balanced part of the portfolio, the fixed income and alternatives. We've heavily weighted the assets towards alternatives. Alternatives have a similar volatility to fixed income. However, they're not interest rate dependent. And we believe that the overweighting, we have 80% of the 8 out of 10 of the positions in alternatives. And we think that combination of a very diversified multi-strategy approach will do well going forward, even when bonds aren't looking very good. Thank you very much. And we look forward to a great 2021.
Awesome. Thank you so much, Tom. There's a lot of information there, and I can't tell you how important it is and valuable it is to kind of cut through all the headlines and all the noises out there. So thank you for that outlook and that overview of kind of where you're seeing things at. With that, just a quick reminder to everybody, we want you to be informed. We want to communicate to you that the trust that you've placed in us is incredibly valuable, and we take it very, very seriously. So again, just a quick reminder, if you want to kind of cut through the noise and know what's happening on a weekly basis, tune in on Mondays. On Thursdays, I go deep into how SmartMix works, into those alternatives like Tom was just talking about, and which actual holdings we're in, and how the stocks are picked, and all those different decisions that are made. And then plan on having Tom back on a regular basis to do this, and so we'll update the content and always be as up to date as possible. So again, thank you, Tom, very much. I'm going to head over here to the chat box, see if anybody has any questions for you. So if you have any questions, go ahead and open up that chat box and put them right in there, and I will bring them to Tom. And right now, I'm not seeing anything, Tom. So let's see if I can give it another minute here, see if anybody comes up with any questions for you. But usually that means you covered everything. So thank you. All right, anybody have any questions? I see a bunch of you on the call here. So going once, going twice. All right, well, with that then, I will close out our meeting, unless Tom, you have anything else that you want to add real quick?
No, but let's have a great celebration of a brand new year, and we've made it through this year. So hopefully this will be a much better year than last year.
Isn't that the truth? Well said. Well, and
Happy New Year.
You, Tom, and to everybody else, Happy New Year. And for those of you that are on the call tonight, we've got wine tasting with Tony the Wine Guy. If you're not on it, head on over to the website, RSVP for that. We're really looking forward to that at 6 o'clock tonight. Tony's going to wow us for an hour with wine pairing, and I've seen him, and he's just a real treat. So hopefully we'll see you guys there. And if I don't, have a very happy New Year. We'll talk to you all soon. Thanks again, Tom.
Bye, Eric. Bye, everybody.